Waheguru Ji Ka Khalsa, Waheguru Ji Ka Fateh. Welcome to another edition of Canada Talks. I'm your host, Bhagwan Singh, and I'm joined in the studio by my friend, colleague, and resident expert, Martin Singh.
Waheguru Ji Ka Khalsa, Waheguru Ji Ka Fateh. Paji, pleasure again.
Paji, you know, there's something that we all have in common.
Yeah.
Right? I mean, there's many...
Grey beards.
Grey beards. Grey beards, that's not one of our greatest characteristics.
Yeah.
But there is something that on the financial side we all have in common, right?
Yeah.
Even though you're a businessman and sort of petty bourgeois.
Oh, you're insulting me on the show.
But as well as the military man and the farm assistant.
Sure.
An engineer, and I work for a trade union.
Yes.
So we do have our differences on that score, but we have one thing though, we earn money.
That's it.
And we put it in a bank.
Yep.
And recently there's been jitters in the banking system.
Yes.
Right. There's the...
Not so much in Canada, but in other places,
in other places as well, the Swiss.
Yeah.
But the US as well.
Yeah.
So, Baji... well, actually, the point is saying not so much in Canada. That's one of the questions further down the road.
Yes.
What's happened? Silicon Valley Bank. What happened with the Swiss bank?
Yeah, Credit Suisse. Yeah.
Credit Suisse.
Yeah.
So let's start with the Silicon Valley for the neighbor down south, which is always such a huge elephant.
Yeah.
Right. What happened? Is it start of anything bigger to come?
Okay. So what it is that the United States has a much more decentralized banking system than we do here in Canada. So in Canada, we have like the chartered banks, of which there are not many, like 5, I think, and
that's TD and
the RBC and Scotiabank and Bank of Montreal and CIBC, right? Those are the big 5, and now, that being said, though, as much as we look at them as the Canadian banks, they do have, a lot of exposure down south because they do own assets down there significantly. And then even further afield than that, like Scotiabank has always had a very big presence in the Caribbean because of the colonial trade routes that used to go between Eastern Canada and the Caribbean way back in the day. But the American system is very different. Like there are some states that have rules in place such that banks can really never get big, as it were. And so you have like mom and pop banks all over the place and a number of regional banks. So Silicon Valley Bank, what happened there? So when we look at it, it actually digs back more at the fundamentals of the economy. Yeah. So many banks, what they were doing to with the money that people were depositing them, they were purchasing government bonds. And government bonds are generally seen as a solid asset because they're very, very safe. Like you don't expect the U.S. government to default on its bond payments, as it were. But the challenge with bonds is that they have an inverse relationship with interest rates. So as interest rates go up, the value of a bond will drop, which means the asset value of any group of bonds inside of a bank starts to drop as well. And so like if a bank is solid, they can wait it out or they can offset it with, other assets they have, et cetera, et cetera. But if people start to get concerned, then they can start to pull their money out.
Right.
And this is what started to happen with Silicon Valley Bank. So Silicon Valley Bank has a clientele base that's primarily very wealthy people, in the Silicon Valley economy. So you were talking venture capitalists and other entrepreneurs, et cetera, et cetera. Why is this significant? Well, when we look at the United States banking system generally, there is an organization called the FDIC, so the Federal Deposit Insurance Corporation, and they guarantee deposits up to $250,000 US. So if you in your bank account have up to that amount and the bank goes, kaput, you are covered. But you're not covered for anything over that. And the challenge with Silicon Valley Bank is that they had many of their clients that had over that amount. And to give you an idea of how quick they started pulling their money out, I think it was $47 billion worth of withdrawals in like 1 or 2 days. It was off the charts.
What participation? What started it? Like, is it you and I talking and things are going down?
Well, like so back in the days before the internet and that sort of thing, people would figure out that there's a run on the banks by walking by their local bank and seeing a lineup of people trying to get their money out. I guess that still could happen, but with online banking, what it does is that, they say that, like, I'm not sure it was Twitter exactly, but one of the commentators said it was the first Twitter-inspired bank failure in the United States. And so it started going through social media, like chat channels, which is not entirely surprising, given the type of clientele that you're working with, also. And so you had all these people there who were concerned that the significant amounts of money that they had over and above the 250,000 FDIC threshold would not be guaranteed. And so they started pulling their cash out. And of course, if it doesn't matter which bank it is, if all the money starts getting withdrawn, they're done, So that's basically what happened there. And what it is that in terms of volume, it is hugely significant. It's the second largest ever bank failure in the United States. Their total asset value, if I remember correctly, was just north of $200 billion. That's nothing to shake a stick at, And what it is that it was, you could call it a catastrophic failure, because in order to shore up confidence, the President of the United States had to come in and say, hey, not only are we, ensuring that the FDIC covers the $250,000, all of the money you have deposited in the bank will be covered, and they did that for Silicon Valley Bank, and then not long after there was a bank in New York City, Signature Bank, who ended up going under as well. The third largest bank failure in United States history. So you have your number one and your number two. And what it is that the government's on the hook for a huge amount of cash. This is significant. Why? Because there was a bank, I think it was in 2008 when they had the mortgage crisis down there in the United States. There was a bank that went under there. I can't remember the exact name. It was like Washington, D.C. Bank or something like that. That was the largest ever bank failure. It was like $400 billion. But that one really didn't cost the government any money, because what happened was that bank was picked up by JP Morgan Chase, and it was just taken care of because they had sufficient liquidity to cover it. But yeah, so what it is that that's not the case now, and so the taxpayer is going to have to come in via the federal government to guarantee and shore it up, and basically it's closed up. And what happened, like there was some involvement on the Canadian side with that as well. So Silicon Valley Bank did have assets in Canada. They were taken over by the federal government, and I forget the body that does that. Unfortunately, I should remember the name for that, but I don't. And so they took over those assets, and the assets are specifically designed, being held to be handed over to the FDIC so that they can be liquidated, and then that money be used to pay out depositors so that they don't lose their money.
And the UK is the HSBC took over Silicon Valley.
Oh, in the UK did it? Okay, I wasn't aware of that. Yeah.
Hong Kong. So I'm pretty sure that, but I'm pretty sure that that's what happened there.
Yeah.
But which is, people talking about the rise of China.
Yeah.
Right there, taking over basically a US bank. What does it mean?
So,
like the other top rate didn't affect us so much in Canada.
Well, yeah, so there was all kinds of concerns that were being voiced there, because like what it is, Moody's came out and put 6 other banks on a credit risk. Among them was First Republic. So First Republic is a bank that's based out of San Francisco. So not that we know our geography in California very, very well, but San Francisco's not that far from Silicon Valley. And the type of investor in First Republic was very similar to the one in Silicon Valley Bank. And so what happened there was 11 other larger U.S. banks came in and provided liquidity to First Republic to make sure that it didn't have the same problems that Silicon Valley Bank had, because there was starting to be a run on them as well. Like folks were taking out their money, their stock dropped like 33% in like a day or something like that. Like it was like all kinds of chaos was happening there.
What happened in Switzerland?
Okay, So what happened in Switzerland, like people kind of see it tied together, and I think that maybe one precipitated the other. But like when you talk about Signature Valley Bank and rather Silicon Valley Bank and Signature Bank and First Republic, on the face of it, they are banks that should not fail. It's not that they were necessarily badly managed or they weren't well capitalized or whatever the case may be, at least not on the surface. The Securities Exchange Commission and others are doing investigations now to find out what went on there, but Credit Suisse had problems for years. They didn't manage their money well. There was all kinds of issues going on there. And what it was is that one of their main shareholders, which is, and creditors, which is a Saudi bank actually, was not allowed due to regulations. And I don't know if it was Swiss regulations or European regulations, but wasn't allowed to further capitalize them. And so in the end, what happened there is that there was effectively a buyout by the other major Swiss bank, UBS, and they were just taken over. And I don't know if like their name brand is gone or whatever the case may be, but it's a significant piece because Credit Suisse, I think, is one of the top 30 banks in the world
Yeah.
in terms of financial markets and that sort of thing. And beyond that, I think they have like 50,000 employees. They have like 5,000 employees in London alone. London is a financial center for the world, right? So, not surprising, but still like...
It's significant.
Yeah, a serious number of folks,
What does this mean now?
Yeah.
Like you've had the Swiss, which is always like in our mindset anyways, everything's Switzerland as secure,
Yeah.
right?
Yeah. I think we're more secure in Canada, but I hear you. Like generally it's seen as very secure, yeah.
Very secure. And the US, which is the economy engine of the world.
Yeah.
Banks going down there. There hasn't been anything significant since, from what I gather.
Yeah.
But we're not financial planners and far from it. But what does it mean for the average working class person, the person who earns their the paycheck?
Well, it's a challenge, right? Because what it is that, let's say, for example, a bank has a large amount of their money invested in government bonds. If the interest rate continues to increase, the value of those bonds drop. If people get skittish and start pulling out their money, the bank then has to sell those government bonds in order to get the liquid cash to pay out, for the withdrawals. But that sale of bonds puts further downward pressure on the value of those bonds. Not just that for that bank, but for all banks. Do you see where I'm going with that? And so it can precipitate, something of a problem. For here in Canada, I don't see us as having any issues at all. When we talk about bank failures, name a bank failure in Canada.
No, can't think.
Well, you can't. You can't think of one, right? Well,
why is that? Why it doesn't fail here, and why does it fail in the US?
Well, the U.S. because you have all kinds of banks all over the place, and that are under different sets of regulations, potentially state by state by state by state, and some of the regulations there are much more loose than what we got going on in Canada. The last real bank failure that we had in Canada, and this is the reason why you can't remember it, happened in 1923. So there was a bank that was created in the late 1800s by a Catholic senator out of Toronto, mostly I think to serve the Irish Catholic population in Toronto, and eventually it evolved into Home Bank. It also had a significant presence in Western Canada, and it basically just wasn't run very well. So there were concerns raised by one of their representatives in Winnipeg prior to World War I. And he started expressing concerns to the members of the directors of the board that resided in Western Canada, because Western Canada was getting irritated with the fact that a lot of the money that existed in the nation generally was being invested in what they would call Eastern Canada, I would call it Central Canada, so Ontario and Quebec, because I'm originally from the East, and no money was getting invested there.
Some things have just remained the same.
Yeah. Well, there you are, and so what it is that they were getting irritated with that. But this particular person had concerns then. I think his name was McAuliffe, I think it was, and out of Winnipeg. But what it was is that World War I started, and so folks didn't want to really rock the boat in any way during World War I. So what happened then is that after World War I, the same gentleman in Winnipeg penned a letter to say, hey, this is a problem. And he was going to write it to the Minister of Finance of Canada. Instead, he wrote it to the board of directors for the bank, who promptly fired him. He then penned a second letter and sent that one to the Minister of Finance. And in 1923, over a span of a number of different weeks, there was a bunch of people who lost their money. A number of them were farmers out west, which was double tragic because you might, if you remember your history from then, that was also the Dust Bowl season when a lot of them lost their crops anyways and their land and everything. So really a difficult time for them. And the other group that really lost a lot of their money was the Catholic population in Toronto that had originally invested way back when it was first set up by the Catholic senator.
But come today.
Yeah.
Just last 5 minutes or so left.
Yeah.
Today, what does these banking failures mean for you and I?
Like in Canada, I'm not sure that it means. I'm not sure that it means a whole lot to us, to be frank. I mean.
So that's Canada, but what does it mean in the U.S.?
So in the U.S., like I said, like it's a huge challenge. Now for those people who have fewer than $250,000 in the bank, presumably they'll be covered by the FDIC, and so they should be, they should do all right. But the thing is that, like, if the banking system is generally, not considered to be sound, and people get worried, even if they are protected by the FDIC, how many people know that they're protected by the FDIC? I would argue relatively few. And so they'll go and they'll start to withdraw their funds, at least their cash assets, right? They might not be able to cash out of their other, investment vehicles in the same way, even if they even have them. And so I think it's that level of uncertainty that causes a lot of difficulty for people because they actually don't know what to do, And the thing is that if you take not that your money earns huge savings right now anyways, and we might actually want to do a story on that about how, even though interest rates are going up, the interest rates on people's savings and checkings account is not, and we might want to have a discussion about why that is, because traditionally they were supposed to walk, in the same direction, but they aren't. But inflation is certainly still creeping up. So if you take your money out of the bank and you earn nothing on it, or if you take it out of investments and just stuff it, underneath your mattress, as it were, you end up becoming poorer day by day as well. And so you're kind of screwed if you do and screwed if you don't. And that's a very unsettling feeling for many people because financially they're not doing particularly well.
So that's the U.S. Worldwide, what implications does this have?
I think that worldwide, that we're probably still doing all right. I mean, as much as interest rates may still increase here in North America and they may further drive down bond values, the different other arms of the U.S., Canadian government, banking system, etc., have the ability to provide the cash liquidity there in order to make it work. I think that there's probably going to have to be a conscientious effort on somebody's part to look at the role that social media plays in this and the fact that you're able to do withdrawals, online and that sort of thing, because and you wouldn't want to ever say that people should not be allowed to withdraw their money because that would be a bit rude, but some thinking has to go on there to say, hey, what protections can be put in place, because as much as the capitalists say, if a bank fails, then it works for everybody else because people learn from that particular mistake and that sort of thing. But when the bank is like $200 billion, right?
Yeah,
like
significant.
that's a lot of folks' assets,
That's
they get flushed, right? And when you look through the list of the bank failures, I mean, that one was number 2. Signature Bank was number 3. I don't remember the exact number for them, but I think it was ballpark around 100 billion, right? 4, 5, 6, and 7, all the way down to number 15 are all in the billions, Like a lot of people have potential to not do well in those particular scenarios, and so and it's not good for the economy either, and so it's a challenge, Baji, because like the United States too, like where their system is so fragmented, state by state by state, I think it would be really difficult to get any kind of unification, in terms of an effort to try to bring positive change.
So, Paji, in terms of for you and I, right? Should we really worried about the banking system? I mean, and what does it mean? Because look, it was just 2008 when everything seemed to go. And there's always that in the back of our mind, right?
Yeah. Well,
are we looking at that today?
No, I wouldn't say that we are, right? So remember what 2008 was. 2008 was a scenario whereby there was a huge relaxation in terms of the regulations around the provision of mortgages in the United States. And mortgages are generally seen as being AAA, right? Meaning that people normally always pay their mortgage and that sort of thing, and there's very low risk. And so what happens is that people were getting these mortgages. When I say people, banks were putting out the mortgages, and what to do is that the banks would collect up the mortgages, and then they would actually sell the mortgages as a financial investment itself, and they were getting traded as being AAA when in fact they were quadruple F, right? And that sort of thing, and that's why things went to pieces there, and included in that was a discussion about Fannie Mae and Freddie Mac, I think, are the names of the 2 big mortgage corporations down there in the United States, and that's when I think it was Lehman Brothers collapsed. The Washington Bank that I mentioned previously, the number 1, that was in 2008 as well. Now, mind you, it was taken over by JP Morgan Chase. But like the United States, I find, tends to cycle through this period, of about, every 20 or 30 years or something like that, whereby, folks get into power, they deregulate, and then what happens is that everything goes to pieces. And then they put in regulations again to try to fix it, and then government officials come in, not for any economic reason, but more for political philosophical reasons, to say, hey, we're in favor of deregulation, until they deregulate too far, and then people start taking advantage of the system. The same was true in the late 1980s. Like there was another banking crisis scandal that went on there, again, a bunch of banks went under. Savings and loans crisis is what that one was called. But there are still some things that have lasted through the years. So, as an example, we mentioned the FDIC earlier, the Federal Deposit Insurance Corporation. It was created back in like the 1930s during the Great Depression to, make sure that depositors had some kind of security with respect to their money. One of the things that they're talking about now, and I don't know how realistic it is or not, but they're saying that deposits, no matter what their size in the United States, should be guaranteed. And if you do that, I mean, you're protecting the rich there even more, and so some folks in government might take issue with that. But what they're saying is that if you provide that kind of security, then those folks wouldn't be so inclined to strip their money out of the banking system so quickly and
shore up the banks.
Well, that's it. And the thing is that they have, like, how shall I put this?
If someone,
if someone has $10 million in the bank, $250,000 is a small amount, compared to the total amount for them, So you're able to provide, not guarantees, but you're able to provide more security for liquidity by putting in those provisions. And like I said, that's what was done for Silicon Valley Bank and Signature Bank.
But you're going to have to stop it here.
Okay.
Which is a shame.
It is a shame.
It is a shame, but till next time.
Yes.
Everyone say safe, secure, and in Chardi Kala. Waheguru Ji Ka Khalsa, Waheguru Ji Ki Fateh.